This is a brief overview of subsequent measurement of fixed assets and intangibles, the amortization in Chapter 11. So Chapter 11 is all about subsequent measurement. Remember that subsequent measurement covers all of those ideas that arise after you initially record the asset and put it into use. Most familiar to you is this idea of depreciation. Depreciation is a subset of the broader term amortization. Popular opinion among non-accountants, or those early in their studies, is that depreciation is necessary because assets inherently lose value over time. But in fact, the term amortization is a systematic way to spread the cost of the asset across its useful life. So it's essentially matching the cost of the asset to the benefits received from its use. In order to calculate amortization, you have to know three key things. You have to know the allocation method, the allocation base, and the useful life. You're going to have numerous opportunities in this module to look at those three key things. The allocation method, for our purposes in Chapter 11, you should be comfortable with the temporal methods. Those are the time-based methods of straight line, double declining, and sum of the year's digits. And you will become familiar with the activity-based method called units of production. When it comes to the allocation base, this is simply the total dollar amount that's going to be amortized. This is calculated as the cost less the salvage value. Remember, the salvage value is the amount you expect to get out of the asset after you're finished with it. And if you don't see one clearly stated in a problem, you assume it to be zero. The third key thing that you need to do the amortization is the useful life. Now, for the temporal methods, this is the number of years or months you expect to use the asset. And for the activity-based methods, this is the number of activity units you expect to get out of the asset. Just as an aside, if you were to look into the codification, remember that's the GAAP rule book, if you will, you wouldn't find a how-to guide for the different methods that are presented in your textbook. GAAP doesn't get that specific. GAAP just requires that the method be systematic and rational. There's only a couple of methods mentioned, but no real details on how to compute. Now, depreciation is the term that we use when we're amortizing fixed assets. By tradition, with the fixed assets, we also use an account called accumulated depreciation, which is a contra asset to the fixed asset accounts. You remember contra asset from your earlier accounting classes. It sits on the same side as the assets, but carries a credit balance. Amortization is the term we use when we amortize intangible assets that are subject to amortization. Remember, we mentioned briefly in Chapter 10 that there are some intangible assets that are not going to be depreciated, and we'll talk about those more throughout this module as well. Finally, depletion is the term we use to recognize the using up of a natural resource, and while it looks very much like depreciation or amortization, it's not an expense. Again, there's more on that in another short video that talks about depletion. After we start amortizing or depreciating an asset, the carrying value or book value of the asset decreases. If you haven't learned it before, you'll want to become very comfortable with the idea of carrying value. It's the original cost of the asset minus the accumulated depreciation. So that is called the carrying value. It's also called the book value. It's the cost of the asset minus the accumulated depreciation or the amortization to date. These basic amortization topics should be a review for most everyone. Be comfortable with the calculations and reporting concepts, but don't spend all of your time in the Chapter 11 module on amortization, because this is the easy part of Chapter 11. Most of your energy in this chapter is actually going to be spent with the less familiar subsequent measurement aspects of depreciation, such as changes in method or useful life, and with the less familiar subsequent measurement topics of impairment and the subsequent measurement topic of accretion when there's an asset retirement obligation involved. Each of these ideas are going to be introduced separately, in a different overview.